Excellent. Well, I know there are some more participants to come, but we did say we would start at 2, so I think we will kick off.
Okay.
So welcome, Jennifer. Thank you so much for your time.
No worries. Thanks for having me, everyone. Good to meet you all.
Jennifer has been in the accounting field for some 25 years. She must have started when she was just a pup.
Younger, a lot younger than I am now.
And has had her own business at Total Textile at Forest Lake there for over 12 years. So very experienced in not only the industry, but a businesswoman herself and understanding the economy and how it plays out for us all. So as I said, thank you, Jennifer. We really appreciate your time to share with our students, our fellow real estate owners and those in the industry.
No, more than happy to be here. Nice to meet you all.
Thank you. So Jennifer thought she might start just on trust accounting, because it's probably what's on a lot of people's minds in 2 weeks' time. And I suppose my question, Jennifer, I have come across 2 differing opinions, if you like, from auditors that we must have everything done, sold, signed, delivered by the 30th, and other auditors who say, no, it must all be done on the 1st of July.
This is an age-old question, I think. Look, I'll be honest, the Office of Fair Trading would like it done on the last day of the month. You know, they absolutely prefer that everything is settled on the last day of the month. But my position on that is that you don't have the statement for the last day of the month until the next day. So from just having discussions with OFT in the past, they've basically said that they will overlook one day. They will give it grace, but technically, no, it's supposed to be the day before. It's a little bit of an unofficial sort of let, if you like. And of course, that's you know, for everyone's end of month, that's every month. It's not just, I guess, end of financial year. It's that's how they like you to do all of your trust accounting reconciliations, doing them on that last day of the month.
Interesting. I know in the Trust Accounts Guide it says that legislation-wise, the reconciliation must be done within 5 days of the end of the month. So even that's another differing of information, isn't it?
I think the problem is from seeing how it all happens practically, when we're looking at the actual trust accounting software, regardless of what package you use, yes, there is a problem if you go in, you know, and it depends on the date that you are doing that process. But what we've found is that quite often, if you're doing it even within sort of anything after about 2 or 3 days beyond the end of the month, a lot of packages now start to actually stop you from being able to properly reconcile. So then we end up with quite a few issues and exceptions in the trust account reconciliation report. So it's just one of those things. If you can do it on the actual day or as close as possible, it's always best.
Aim to the last day of the month.
Yeah. And I guess the one thing that I'll say just with regards to the trust accounts, it's really on our radar at the moment is, from what we understand, the Office of Fair Trading is taking an enormous amount of time to process corporate trust account, you know, and real estate license applications. So we've had quite a few, you know, new agents that are sort of striking out into their own business that have set up companies to do so. And in the end, they've had to actually start operating as a sole trader and open up a trust account as a sole trader because they've got their individual license until the company license comes through.
I didn't think of that. Teaching myself and Paul, I teach the registration to get people into the industry, and Paul teach the next one. And I was aware that the Office of Fair Trading are taking 12 weeks to process these, but I didn't think of that other side of it, that then trust accounting and establishing themselves in our residential letting agents that need that license and that trust account. So good tip for people to allow time.
That's it. And we've actually had one case where it was picked up by the Office of Fair Trading before it came for audit, but they actually picked up on the fact that there was someone that was operating a trust account in a company that didn't have the license yet. So they've got some sort of ability to do some checking there. And you know, obviously that causes a bit of a problem, and it's not, I guess, the great way to start your track record with the Office of Fair Trading.
Absolutely. I was blessed when I opened my office 3 months into being open. A gentleman walked in the door, put his card on the reception desk, and he was from the Office of Fair Trading there to do a spot audit.
Wow.
3 months. So it happens.
Yeah.
a new suburb, and they were just going through every agency in that suburb. So
yeah.
They are out on the road and obviously checking on trust accounts. That's interesting that they've got the wherewithal now to...
From my understanding from the particulars of that case, it seems like they've got some arrangement with the bank so that as they're set up as a trust account, they're able to data match and make sure that there's a license that matches. So yeah, it's just one of those data gathering things that have just gotten very, very effective.
Wow. Yeah, so be aware, students.
Mm-hmm.
Thank you. And students, if you do have any, or participants, if you do have any questions for Jennifer, just pop them in the chat box for me. We were looking at trust accounting initially. Anything else on trust accounting, Jennifer, you think we need to touch on?
No, look, I guess one of the bigger issues that we sort of bump up against now, particularly as a lot of clients are using the software packages like Eagle and Property Me, Property Tree. They're really good packages, but it's one of those things. It's just it all comes. It's just one of those things. It's an industry where I guess everyone's got to get into that mindset of the reconciliations have to be done sooner rather than later, because one of the biggest problems we find that if you're not keeping the software updated every day, that you can run the risk of using one set of clients' funds to pay for expenses for another client. So, and that's really what the Office of Fair Trading focuses on. They really want to make sure that you're not borrowing from Peter to pay Paul's property expenses. So, and the only way that you can be 100% sure is if those packages are up to date really every day, because all it takes is, one extra realestate.com.au, invoice, against a property that you haven't entered into the system yet. And then, before you realize it, that client didn't have any money to pay for it, and you've actually used somebody else's trust monies to pay. So that's, a really good reason just to keep it up to date.
Ledgers must be accurate. I had the issue myself. We used Console and I was out $2.50 in my reconciliation. I had to call the auditor in. We couldn't find it. Nobody could find it. It was at audit period. She had to report to the OFT that we're $2.50 out. And eventually Console had to go in the back end, and there was actually a bug in my software that had reversed something that nobody could see, that they could see. So there are instances where you'll get reported to the OFT. Mm-hmm. You've got to keep those reconciliations up. And I strongly believe in daily reconciliations. Transactions that most agencies do. Yep. You don't have to do it daily. So thank you. So that's our trust account. And we thought we might move on, guys, towards PAYG, to our agents out there in Zoom land who are all making a mozza of money now, making a killing.
That's it. Mm-hmm. Yes.
Yeah. And
nothing better than a good year.
Yeah, that's right.
Yeah.
What sort of things should they be looking at? What will the tax office be targeting on them, this increase in income?
Okay. All right. Well, the good news is that they don't tend to target groups of occupations anymore. So the old way of sort of targeting teachers for the year, or truck drivers for the year, or real estate agents for the year for audit, that doesn't happen anymore. They don't target occupations. What they do is they focus on the overall level of your work deductions and how much that's outside the average of other real estate agents. So they have, all of anyone that specifies their occupation as a real estate in their tax return, they gather all of that information and they can work out what the average deductions of a real estate agent in any year are. And so it's about making sure that, if you have a year where you've got a lot of costs and everything, that you just make sure that all of your record keeping is done and that you make yourself as bulletproof as possible. So some of the things that you can do that are really important, it's things like, for example, motor vehicle. I think you'd all agree that basically the car is your biggest office. I'm sure you spend more time in the car a lot of the time than you do in your actual offices. So, they generally tend to be really highly work use. So in order to make sure that that's okay from the tax office point of view, you've got to keep a logbook for 12 weeks. So that's one thing that's really, really important. And it's quite surprising the amount of people that don't keep it. When the ATO have got a few stats, and when they've audited taxpayers before, not just real estate agents, but any sort of taxpayer, in the end, over 50% of people that they audit don't even send a logbook in. So this is sort of the amount that sort of don't appear. So it means that the ATO know they've got a really easy target. So they tend to pick people for motor vehicle expenses. If your motor vehicle expenses are quite high, expecting that half won't have logbooks to start with. So if you can start with that, you know, you're basically ahead of the game right there and there. And there's some, you know, there's different ways of doing it. You've got your old paper book, you've got some apps that are around that I'll talk about a bit later. So there's all sorts of way of keeping it. You only have to keep it for 12 weeks, and that one logbook will do you for 5 years. So you only got to do it once. You've only got to do it for 12 weeks, and then you don't have to do it again for 5 years, unless, you know, you're using the car more for work and you want to bump that percentage up. So that'd be a good reason to do another logbook. But that's really important. Another thing that's really important is, you know, in your industry, you know, there tends to be a lot of gifts and, you know, thank yous and, you know, a lot of sort of things that make the world go round. So because of that, it's really important you are able to claim the gifts that you buy for clients. You know, that's something that you're able to do, but it's really important that you do keep records. So for example, if you buy, you know, a client a bottle of champagne, you buy them some flowers and everything, it's just really important that you keep the tax invoice and that you also specify on that invoice or receipt who it was for, because that's what the ATO expects you to be able to do. They expect if you're going to claim $100 for a bottle of champagne for a client, you know, because of a big sale, that you know exactly who that client was and what sale it related to. Because I guess the whole thing that the tax system is built on is that in order to claim something, it has to be spent in order to produce income. That is, if, you know, if I boil the tax system down to one thing, that's what it comes down to. So that's why it's really important that you're able to prove that that bottle of champagne was for a client and not for yourself. So it's just that type of thing. So that's really important. And I guess the other thing that sort of leads into that is there's a lot of meals and coffees and things that get bought, you know, particularly in real estate, and you're always able to claim what you buy for other people. So if you meet with a client, if you meet with a prospective client, someone that you are, you know, selling a house for, you can absolutely claim whatever you spend on that client because you're doing it in order to produce income from them, hopefully down the track. But you can't claim your own. You can't claim your own coffees. You can't claim your own meals unless you're actually traveling for work overnight. So that's just one really important thing to bear in mind. The only other sort of situations where you can claim meals is if you get an overtime meal allowance, but that would be unheard of in real estate. I'd be very surprised if anyone was collecting an overtime meal allowance from their employer, even if you should be. So I think that's probably not going to apply to most people. So that's, again, you know, just don't claim your own, but definitely claim other people's. And then again, it's a matter of keeping a receipt or a tax invoice and writing exactly who you met with and who had what. And it really does come down to that level of sort of record keeping. So if you can do that, again, that's great.
On that record keeping, because these, what are they called now? Thermal receipts, they all fade.
They do.
Keep them. So should we, if we keep a record of them, a Excel spreadsheet?
Well, I've got an app that I'm going to talk about a little bit at the end, which would be really helpful, but I'll also talk about how you sort of, you do need a bit beyond that. So if you like, I can talk about that now. So there is an app, it's called My Deductions. And so it's quite a good app. It's issued by the ATO, so you can download it for free. And basically it just has it's really no more than just a camera in an app. And so basically you take a picture of your receipt, and it just means that when it uploads the picture, you can just flick it into a folder. So you could flick it into your motor vehicle expenses folder, you could flick it into your meals, you could flick it into your client gifts. So it is a really good way. And then that way you can just throw the receipt out straight away. Okay. And in terms of keeping records, I guess, you know, I ask people sometimes, you know, how long do you think you have to keep your records for? And it's quite surprising. Some people say 7 years, some people say 5 years, some people say 2 years. If you're a salary and wage earner, so you're an employee, most of the time you only have to keep records for 2 years. So having said that, though, the tax office always put a disclaimer at the end of that if they believe that there's, you know, serious tax evasion, if they audit you for the last 2 years and they think there's serious tax evasion, they can basically go back as far as they like, but they've got to have a valid reason for doing so. They can't just suddenly decide to audit you for 5 years ago out of the blue. So it's not quite a get out of jail free card if you've gone, 2 years past your period of time. But if you've gone past 2 years, the end of the financial year, and there's no reason for them to look back because of something that's happened in the future, you're safe at that stage. So you can start shredding after 2 years after you've lodged the tax return.
The salary and wages only are company.
Yeah, salary and wages only. It's a bit different for business owners. If you do have your own business, if you are starting out and you're running your own agency, it's 5 years at least, I think. And it used to be 7. It did used to be 7 for ASIC, and for the ATO, I advise 5. For a lot of small businesses, the tax office will still lump you into the 2-year bracket, but it's one of those things. You're never quite sure at the beginning if they've done that. And so I just think it's best to have 5 years worth. Yeah, just experience has borne out.
Okay, that's good to know. Somebody in the field.
Yeah. And then I guess a couple of other items that are really important is home office. Everyone does some work from home. And so that's one of the really big things that comes up when we're putting tax together. So in terms of what you can claim, if you work from home and you have a place of employment elsewhere, so you have an office or something that you've got, even if it's just a desk or even just a chair, if you've got an office that you can work from, then basically when you work from home, you're restricted to only being able to claim office running costs. So you can claim, electricity based on the hours that you do. The ATO have a set rate at the moment of 52 cents an hour that you claim for electricity. So you just have to keep a record. If you can keep a log for 30 days, we say a month basically establishes what you've done at home for the year. So let's say, for example, that we're in June now, so you might choose to even keep the record for June. And so if you can just jot down in your diaries or your calendars somewhere just how many hours you've spent working at home, and it just means that that's all the ATO requires you to do to prove the electricity usage. So that's quite easy to do, I think. So if you're able to do that, you can claim electricity on that basis. You can also claim percentages of internet. For example, if you're using your home internet to work while you're at home, I don't think we can do much without the internet these days. So either, mobile phone, internet, consumables, stationery, anything like that, office furniture. If you have an air conditioner, if you do have a dedicated sort of office, the space that you work in, that enables you to claim a little bit extra, I guess, in the way of air conditioning and stuff like that, because you can actually point to a particular area. And it's really important, this area, if you are going to claim that type of thing, it can't be used for any other purpose other than work. So it's got to be a room that you can say is set aside. The other thing that comes up a lot with home office is a lot of people ask, can we claim a proportion of our rent? Because we're not just, working from home, this is where we work from. And so the tax office, the rule of thumb that they use is if you have an office to go to. So basically, if working from home is a choice because you choose to work from home rather than the office, you can only claim running expenses. So you can really only claim electricity, you can claim, stationery, all of that type of thing. However, if you don't have an office, and that's happened quite a bit over the last couple of years, it's quite amazing as people work from home, and a lot of places, gave up their leases, or they just, really compacted their rent space. A lot of people now, because they've ended up working so much from home, they don't have offices. They actually don't have, a dedicated location. So those people are actually able to claim a percentage of their occupation costs at home. So for example, if they're renting a place and they're using, one room as a dedicated office, they don't have another office to go to, that's their only basic workplace other than on the road, then you've got the ability, whatever that percentage of floor space is, let's say that office represents 15% of the whole house, then you can claim 15% of your rent, you can claim 15% of your electricity, you can claim 15% of a lot of things. But there are ramifications of doing that, particularly if you own the property. So I do advise that you always talk to your tax agent about that type of thing before you move down that path. But there's always something that you can claim for working from home.
It's definitely become a more acceptable means. I know real estate, typically all the property managers were in the office all the time, whereas now they're working from home 1 day a week. It's become more flexible. So it's definitely an area that we need to to invest
Yeah.
in that.
May I ask a question here?
Yes, Cindy. Thank you.
Just wondering if the house is it's not rented, it's on mortgage, that situation, how we do?
What happens there, Cindy, is if the house is being paid on a mortgage, you can still claim, for example, 15% of your mortgage interest. Instead of claiming rent, you would claim 15% of your mortgage interest, 15% of your rates, 15% of your home insurance, 15% of your water. But having said that, it does cause one consequence, and that is that at the moment, if you have your own house, your own main residence, if you sell it, you don't pay capital gains tax because there's no capital gains tax on the sale of a main residence. However, if your main residence starts to be used for business, let's say it's 15%, we work out that that office space takes up 15% of the house. It means that eventually, if you sell that house, that you may have to pay capital gains tax on 15% of the profit, because that's the way the tax office look at it, that if you've used it, you know, to claim 15% of the expenses, then you also then have to report, 15% of the income. So that's why, Cindy, a lot of people, even though they end up not claiming the 15% of interest and rates, because you can still claim electricity, you can still claim all those other items, you just don't claim the mortgage interest.
Yes, got it. Thank you.
No worries.
Thanks, Cindy. Yes, I know. I'm looking at that myself, and I'm just, nope, I'm claiming just electricity and internet. What's the percentage of internet? Is it depend again on the use?
Oh boy, you've opened a can of worms here, Kayleen. It's not great. It's one of those things that the tax office are trying to figure out how they're going to deal with it. They don't really know how they're going to deal with it. They're trying to sort it out. That and mobile phones are the biggest problem areas for them, because mobile phones aren't just phones anymore. They're computers, they're mini computers. And unfortunately, at the moment, in order to justify whatever percentage you claim of your mobile phone, because the onus is on you to actually prove what you use, the only way that you can prove, you know, your usage of a phone is by looking at phone records. So you can only look at your call lists and your texting. But if you think about it, we're probably all using our phones, you know, 50% we're using it mobile. We're using it every day, every minute of every hour of every day at work, to look up things on the phone, to do different things. And unfortunately, at the moment, you can't prove that you use it for that. So at the moment, you're a bit restricted to being able to claim, you know, whatever percentage of calls and texts that you can prove. So it's a little bit of a problem from that point of view, and internet falls into the same thing. So what we've said for internet is if you can just do a log, very similar to the home office electricity. However, so having said that, the one thing, of course, is that, you know, if you think about it, everything uses the internet at home. Our ovens, our fridges, you know, everything sort of, you know, uses the internet, I guess, almost stealthily, you know, like just in the background there. So at the moment, all you can really do is keep a log for 30 days, and you just put into that log everyone's use of the internet, which sounds ridiculous, and it really is. But you know, if you're living at home with a partner, then basically you just fill out this log to just put that, okay, we watched Netflix for 2 hours, you know, on Saturday night, but we did, you know, 5 hours worth of work, you know, on the internet. That's what they expect you to keep for 30 days. It's a bit ridiculous. So at the moment, the tax office is working towards coming up with a better system where they might just say, for example, look, you know, you can claim 50%, you know, of internet, or there'll be a certain percentage, I think, that will be able to be claimed. I think that's where we're heading.
Right, because there's 8 hours, well, maybe 8 hours that we're sleeping and we're not using it. But maybe
that's right. Yes, that's it. And especially if anyone's mining crypto, it never stops. So so yes, so there is that, Raylene. And then I guess in terms of anything else around the home office, that was really about it. You know, I think travel expenses will become something that we can claim a bit more of. And if we're ever away anywhere overnight for business, we can always claim our meals, our coffees, and our accommodation.
Excellent. Well, in the old days, we don't do it anymore, but we have all these digital signatures. But I have been known to jump on a plane, go to Sydney, meet somebody at the airport, get their signature on a sales contract, jump back on the plane, come back to Brisbane. You know, the things we had to do.
Your industry is so much more exciting than ours. I'm jealous listening to that.
Oh, now it's just tap, tap, tap. Here you go, sign away.
A bit more boring, isn't it?
A bit more boring, that's right. Okay, so sorry, yep.
So
the PAYGs?
yeah, that super, I guess, you know, it always, I think, comes back to super, and that's a massive thing at the moment. So, you know, everyone's had a great year, I hope. There's certainly, you know, a lot happening with real estate. So I think people have often ended up on the highest income they ever have. And so we're looking at what are we going to do, because it's great news until we actually get into the accountant's office for tax. And then we're sort of, yeah, it's not so good. So one of the big things is super. Up until 2019, if you didn't use up your cap every year, everyone's got a cap called a concessional cap, and it used to be $25,000 a year. Now it's $27,500 from this year, but it was 25,000, and out of that cap, anything like super from an employer, any super salary sacrifice, you know, anything like that, if you wanted to put that into super and claim it as a deduction, either your employer or yourself, you were capped at $25,000. And if you didn't use it up in 1 year, let's say that it was just your employer paying in super, they paid in $10,000 super for the year, you just lost the rest of that cap. So there were a lot of people that were, you know, it gets to the point where you may not have a lot to put in 1 year, but, you know, quite often 5 years later, if you've had a good couple of years, you've got more money up your sleeve to put into super. So what they did in 2019 is, instead of the cap expiring at the end of the year, they give us 5 years to carry it forward. So what it means is, if you look at 2019, 20 and 21, those are the 3 years that are already done and dusted. We're currently in 22 at the moment. So we've had 3 years that we've got this concept of carry forward caps. So we've got 19, 20, 21, that's $75,000 that could have gone into super if you'd chosen to, either from your employer or by salary sacrifice or making a personal contribution that you claim. So, and I imagine that, you know, especially if most people have only had employer super or lower levels of super, you've got quite a bit left that you can use up there. So that then becomes an option that if you don't want to pay tax, I mean, the tax rates at the moment, you pay 0 up to 18,200. You pay 19% from 18,000 up to 45,000. You pay 32.5% from 45,000 up to 120,000, which is a lot better than it used to be, I have to say. But then anything over 120,000 up to 180, you're then paying 37%, and then anything over 180, you're paying 45. So they do start to really sharply go up. So the tax rate in super is only 15%. And this is where the benefit comes in, that if you can, instead of taking, you know, $10,000 as part of your salary and wages, if you're able to salary sacrifice, or if you're able to make a personal super contribution for $10,000, that goes into super instead. So instead of paying, let's say that, you know, you've had a really good year, that your income's sitting at about 150,000, you know, possibly higher, but let's say it's in that bracket. If you don't put that $10,000 into super, you're going to end up paying $3,900 tax on that. That's 37% plus the 2% Medicare levy. So that's $3,900. So I mean, you'll see in the hand $6,100. If that money goes into super instead, that gets taxed at 15%. So that means, you know, only 1,500 in tax coming out, which means 8.5 is going into the super fund. Now, I realize that cash flow is king. It really is. So this is something that's great to do for tax, but it's only something that you can do if cash flow allows. And I guess a lot of it often depends on what your plans are for the next few years. So it's really important that, I guess, that while it is a great tax strategy, it's amazing in terms of the tax savings. You know, it's quite a while before most of us can access super. So if you're looking at quite a period of time and you've got other plans for, you know, generating wealth in your own name and not having it tucked away in super, you do have to consider that. So I always say, as much as it's great for tax, you've just got to make sure that will actually, you know, you'll still be able to accomplish whatever plans you have in the interim.
I mean, there is the benefit now for young people that they can put it in there and access it as some savings towards homes and things. But for a lot of the people that have families and just at stages of life, they say they need that cash flow. If you can, I think it's a great opportunity. I know I may have had to have dumped a couple of 100,000 when I sold my business into my accountant said, tax man will get his hands on that.
Yes, accountant was right. He had a good accountant, Raylene, that's the good news. So no, and one really important thing with super, if you plan to make a super contribution to try and reduce your tax, the money has got to be in the super fund before 30th of June. And it's one of those things that it can often take the financial system a couple of days to have the money go in. And if the 30th of June happens to fall on a weekend, which it doesn't this year, thank goodness, but if it does fall, onto a weekend, then some clients in the past have missed the boat because they've just left it that little bit too late to 30 June. So if anyone's thinking about doing it, I'd probably advise that you look at doing it sooner rather than later. And then the only other sort of follow up to that is you've got two choices, I guess. In the past, the only way that employees could get, additional super paid in and claim it was via salary sacrifice. They changed that a few years ago. So the situation now is that anybody can make a contribution into super personally without it going through work. And as long as they submit a form to their super fund, letting them know that they're going to claim a tax deduction before they lodge their tax return, very important, got to fill that form in before you lodge the tax return. As long as that happens, then you're fine. You've got the deduction.
Excellent, thank you. And I think that's something that we all do need to look at. Because who knows if pensions are going to be around in the future?
Yeah, look, that's right. And the only other thing I can think of to tell you all in terms of other tax measures is prepayments. The tax office will allow you to claim a prepayment of up to 12 months. So if anyone's got any sort of monthly subscriptions, monthly insurances that they claim, anything like that, maybe you can sort of bring forward a year's worth by paying it in June. And I mean, that doesn't make the tax disappear. You're just bringing forward the deduction. So you're just putting off the timing of the tax. But, it sort of just, it hedges your bets as to whether next year is going to be better or a worse year than the one that we've just had. So it just enables you to just put off paying that tax for 12 months to see how things go.
Yeah, no, that's a good, I forgot about prepayments. Thank you.
Yeah.
Okay, so I think finally is looking at clients and what we can do to help our clients out. Jennifer, at this time of year, whether they be sales or our landlords, what
there's actually something really important, and it's a great time for us to be talking about it because it's really timely. And what it is the fact that from the tax office point of view, for your clients, capital gains is based on contract signing dates. It's not based on settlement. So if you have somebody that decides to purchase a property, so you're looking after the vendor, it just means that if they sign a contract, for example, on the 28th of June, let's use the 28th of June for an example. I actually had someone that signed a contract on the 30th, but I'll come to that in a minute. So we're looking at the 28th of June. Now that's great. Obviously everyone's there to sell the house. It's fantastic. You've achieved an excellent result for your client, the vendor. But having said that, by signing the contract on the 28th, we're not really allowing them enough time to make sure they can get any money into super if they want to make a super contribution to try and reduce tax. Now, I guess if you've got someone that's selling their main residence, they don't always want to make a super contribution as much. But having said that, we do have this super contribution called a downsizer contribution that came in a couple of years ago. So that enables older people that are selling a family home that are going to downsize into a smaller place to put a really big, chunk into super. That type of thing, the downsizer contribution, isn't quite as important because that's not about claiming a tax deduction. But for anyone else, let's say, for example, you've got a client that might be selling a rental property, or even someone that's selling, their main residence, and they've just had a lot of income from business, or they've had a lot of income from work for the year, and their financial advisor and their accountants might be saying, yep, look, this is no worries. You're going to sell this house. You're going to, end up paying this much tax, but we want you to put a big chunk into super, and then that's going to make the tax go away. The problem is if that client signs the contract on the 28th of June, I can pretty much guarantee there's no way that they're going to get that money into super, even if they weren't relying on the proceeds of the sale of the property to put the money into super. Even if they had money sitting in the bank, it's so difficult to make sure that that money hits the super fund before 30 June. Whereas if that contract was signed on the 1st of July, they actually don't have to put money into super for another year, until 30 June the following year. So it can make a massive difference. It really can. I had a case come through in the last year where a client had sold a property, and they came in to get the tax done and they didn't bring the contract with them, but we did ask them to obtain the contract. And when we eventually got the contract had been signed on the 30th of June. So unfortunately, that client had planned to put $75,000 into super because she was a teacher. She was coming up on retirement. You know, it was really worth her while. She was making a large capital gain on the sale of this property. So it was really worth her while to put a big chunk into super. A special needs teacher too. So we're talking about someone that's worked very hard all their life and everything. And unfortunately, we weren't able to do a thing for them because the tax office will allow no wriggle room. There's no mercy when it comes to capital gains tax. It's the contract date. There's no flexibility whatsoever. And unfortunately, if there'd been one day left, you know, if the agent had been aware, and again, look, you know, agents aren't expected to be accountants or tax agents, but it's just one of those things. I actually spoke to the agent that had been involved in the sale, and they are going to bear that in mind for the future, but they weren't aware of it at all. So it's just something that we sort of have just become aware that maybe that's something that needs to be out there a little bit more, because I think if you are involved in a situation like that, if you ensure that the contract gets signed in the new financial year, you basically you're the hero on the riding in on the white horse that saved the day.
Wonderful. I was lucky. I did 7 years in accountancy myself before real estate, so I was aware of that and made my agents aware of it, but not one of those agents that came through my office was aware to look at financial year end. So it's something that's really important, I think, for our participants today to keep in mind, especially a lot of our participants are in property management and in dealing with investment properties.
That's it. And I mean, you know, and it's one of those industries, a lot of the time I understand, you know, once you've got someone ready to sign on that dotted line, you know, nobody wants to push that out, you know, for much longer. We want that contract executed and ready to go, but it's just something to bear in mind.
Yeah, it is. It's an emotional decision, you know, 90% of the time, or 80% of the time, I'm Pareto's rule. So it's something that you do want to get it done. Sign here, press hard.
Yeah.
For the best benefit of the client at the end of the day.
That's it. So if anyone's got any contracts that are likely to be signed in the next couple of weeks, maybe that's just something to just bear in mind, and maybe even just mention to the vendor that if they do have any plans for putting any money into super this year, if they've been talking to their accountant, then that's just something that becomes relevant.
Yeah. So either sign now.
Yes. Yeah. And then you've got 2 weeks, by the way, to get that money into super way before settlement. So yeah, and then that's the other problem, because most of the time people are going to use the settlement funds to put the money into super, and in a case like this where you sign in June and settle in July, there's just no way that you're going to have the money ever to be able to put in June. So that's where I think, you know, that's where you can really carve out a niche for yourself with your clients, because that sort of useful advice is the sort of thing I imagine that would keep people coming back, but also encourage people to spread word of mouth about, you know, how knowledgeable you are.
Yeah. I often say in my training that you have to have a little bit of knowledge about everything in real estate. You've got to have a little bit of tax knowledge, or a little bit of legal knowledge, or legal, but, you know, a little bit of crystal balling on the economy. There's lots of things that we have to be across.
I agree. There's a lot of moving parts to your job. Absolutely.
Very much so. Okay. I think, and the last topic I had was our apps, but I think we covered that, didn't we, with what was our
we did.
So I've lost it.
My Deductions, that's the app for recording just all sorts of receipts and everything, and so that'll just make it really easy. When you go to see your accountant, they'll be so happy, because, you know, instead of handing over a bundle of receipts and everything, you can even just email them all of the photos that you've got and everything in advance, whatever works. But it's a great way of organizing, and the thing is they're there for the end of time, which is fantastic. And then the other one is the logbook, with the vehicle logbooks that you've got to keep. You've got two choices there. You can either go old school, so you can either get the lovely yellow book from the newsagents. It's still yellow, so you can get, oh no, sorry, they're blue now, blue and yellow, so you can have a choice there, blue or yellow. Or the other thing is, there are some good apps around. There's one in particular called Logbook Me. The only reason I mention that one is because it's the one I've seen the most with clients, so that seems to be the most popular one, and that's quite good. But the one comment I'm going to make about electronic logbook apps is that obviously they work with your GPS, which is really handy because, you know, when you get into the vehicle, instead of having to write the odometer and write the address and everything, it's going to know where you're going. And if you've programmed in the odometer at the beginning of keeping the logbook, everything should be right. But just bear in mind that they're very precise. So they're just, yes, they're very precise. So you may find that you may want the flexibility of the paper logbook. You know, you can make mistakes, you can sort of, you know, stuff up, and all you need to do is cross out a line. Whereas I've often wondered with keeping the electronic logbook, you know, if things go a bit wrong halfway in, you know, I think you pretty much stuff then, and you have to sort of go back and start your 12 weeks again. And the other thing that I'll say about logbooks, I've had quite a few clients audited now, you know, having done this for 25 years, you know, we've just, you know, our clients have drawn a few audits, including a couple of real estate clients. And that's been the thing. I've never had an ATO audit officer do any more than ask for a copy of the logbook, because there's so few people that actually keep the logbook. They're that delighted that you've actually kept the logbook and got it in order, and you've got your odometer readings and everything. They don't go beyond that. They don't ask any more questions. There's no need to make sure. They'll never follow up in terms of finding out, you know, who you were seeing on those dates. It's just enough to record, you know, the trip, the address, why you went there, and the fact that it was a work trip. So if you just do perfect records for 12 weeks, you are pretty much bulletproof for 5 years.
That's good to know. I did do that. I'm just trying to rattle through my brain as to where my logbook is.
That's the other thing. Yes, they do disappear. A lot of disappearing logbooks.
Yeah, it was in the glove box, but we'll find it. Well, thank you, Jennifer. I'll just see if any of our participants have any other questions. I think we've been quite, or you have been quite comprehensive in your coverage. Thank you so much of what we're talking about. If anybody wants to put in the chat any questions that they have, and I'll just jump across there. Paul, are you still with us? I'll just see if...
Yes, I am.
Paul, is there anything you'd like to add?
Well, I think Jennifer have pretty much covered most of the points that we often mention to all our clients, and thank you very much, Jennifer. I was like struggling to trying to think of anything you have missed and I ask. I'm still thinking.
Yeah, I'm the same, Paul. I think you've been very comprehensive. It's been wonderful and so plain English, Jennifer, and in your delivery. I really appreciate the way you've been able to talk to us real estate agents so that we can...
No, thank you for having me. You're more than welcome. It's been great to spend the time with you. I'm a bit of a tax nerd. It's a little bit tragic, so I do find all of this stuff interesting. And you know, the one thing I'll say, just keep your receipts, everyone. I've had a couple of real estate agents audited in the past, and there's been absolutely no problem because they've kept receipts. The only ones that have ever run into any problems have been the ones that haven't kept receipts. So honestly, if you do that, you've got your logbook, you'll be fine.
Excellent. Okay. Well, we might leave it there, everyone. I have recorded it. If I can work out the technology to upload to our own portal, we'll see how clever Raylene is, but we really do appreciate Jennifer. And Jennifer is at Total Tax, is her business at Forest Lake. If anyone's looking for a plain speaking, knowledgeable accountant, we think, Jennifer, you're the lady.
We're happy to look after you guys. All the best with everything. I know it's been a hell of a couple of years for you guys, just exactly the same as us. So I have to admit, every Monday morning I was coming into work wondering which client had bought what property that weekend that was going to force me to start cranking out financial statements for the bank. So thank you for that. Much appreciated. But it's all for a good cause. So onwards and upwards, everyone.
It is. Actually, I might just touch on that, Jennifer. We did say we might do a bit of crystal balling, and honestly, that's what it is, crystal balling with economy and economists, etc. We were talking about, and Paul, I'll get your input on this as well, construction costs going through the roof. Builders, you say that we've got builders circling the drain, large and small.
Yes.
I personally have had renovation costs in 3 years, has it been since 2 years, a triple over different quotes. And I know that builders are giving people 10 grand to walk away from the contracts that they had with them. So what effect do you think that might have on the real estate market, Jennifer?
Well, I guess anecdotally, I can say that I know that there have been quite a few clients that have abandoned plans to renovate and to sort of do improvements that have decided that they're going to sell instead. And that's really only come the last few months. I think after the supply issues and the cost of materials, the weather the last few months has really been the last nail in the coffin. That has made operating conditions so hard for the construction at the moment that the price increases that they're just coming through with now are just the final straw for a lot of people. So I'm hopeful that that might help to offset the effect of increased interest rates, you know, and the fact that we sort of are heading for a bit of an economic tightening. You know, things are going to get a little bit tighter, a little bit harder. So I'm very hopeful that that even though, you know, it's obviously not good, the problems that constructions have had, there is going to be a little bit of a payoff for the real estate industry, and I'm hopeful that that will keep the market ticking over for a bit longer.
So more transactions basically, as opposed to more renovations or new builds.
That's right.
Just bonus 5K, and then it says sign-on bonus will be limited to 5K gross and paid it.
I'm just going to mute him. I don't think that was for us.
Yeah. No, I just gathered that. Yes.
Yeah, so yeah, more transactions we'll see. And as you say, I hope construction doesn't suffer in a way that is detrimental.
No, it is. It's tough at the moment. I think the big thing that we're seeing is already, and you'd probably notice it yourselves, it's time on market has already started to increase. But having said that, the agents that I've talked to who are clients are all saying that so far prices aren't dropping, but it's taking longer to sell houses. And I guess it's just then what happens beyond there. It's all a game of dominoes, isn't it?
It is, yeah. One thing leads to the next. Okay. Well, that's all I have for Jennifer. Unless anyone else has anything, I'm just scrolling through the list to see if there's anything. Paul, anything further to add, or you're good?
I just want to check with Jennifer. Like previously, there was mentioning of like a self-managed super fund where we can have up to 6 members. Is it still 4 at the moment, or is it?
No, it went to 6. It
so
did go to
already
6. Yeah, so that's in law now. Yep.
Okay, great. Okay, well now I better talk to my accountant.
Absolutely. And look, one thing again, look, self-managed super and property is something that we've done a lot with over the last few years. I think that's tightened up a little bit, but you might still be lucky. So definitely have a chat.
Yep.
Yeah, actually, that has been something that I notice an impact on with the self-managed super funds buying investment properties, and when they tighten that, I saw a market.
Yes.
Market. I can't think of the word. A direct impact on the market.
Yes, that was that, and that was a decision that was made deliberately. They wanted to cool the SMSF property market, so the bank stopped lending to them. And then the other issue has been that now, if you want to buy one, you've got to have a statement of advice to set up a super fund, and they can cost about $6,000. So definitely something to have a chat to the accountant about.
Excellent. Okay. All right, that's where we'll leave it. Thank you.
All right. Thank
you
for having me, everyone.
You're welcome. I'll stop recording now. Wait a minute, there was something in the chat. Oh, good job, Jen. Okay. Thanks.
Thank you.
That'll be from Deb, I think.
Thanks very much. Have a great afternoon, everyone.
Thanks, guys. See
you.
Bye now. Are you still with me, Deb? Do I have Deb with me? Is there anybody else?
Yes, I am.
Hi, how are you? I'm just going
good. I tuned in a little bit late, but it was very good.
Yeah, no, she's